Welcome to the Pure Property Podcast. Whether you are considering buying your first investment property or reaching property mogul status, we dissect the fundamentals through to large-scale property development and everything in between.
Well, there certainly is a lot in between. Welcome to the Pure Property Podcast with Paul Glossop back in the studio as we get set for trying to unravel what's going on in the economy at the moment and how that's influencing and shaping property markets. So we're going to get stuck into it. Lots of data today. We're going to pull it apart, try and get some sense for it all, synthesize it, and importantly, what do you do all about it? It's one of these things everyone can get absorbed right now, stuck in the weeds of a noise of economic commentary, and it can stifle decision making. So the important thing right now is to, be aware what's going on. Don't be alarmed, just be alert to changes in markets and importantly, how do you capitalize on it? We're going to get into it. Paul Glossop, founder and managing director of Pure Property Investment. Welcome back in the studio. Good to see you.
Thank you, Philip, and thank you for having me between two ferns, or Kentia palms as they would be.
Yes.
Probably, no doubt, very real. And they've been flourishing ever since you've been here.
They have been. Look how green they are.
Even due to lack of water and sunlight, they seem to do amazing.
Well, I always sprinkle them with some diatribe of verbal
diarrhea.
Verbal irrigation typically keeps them going. But you know your way around a Kentia palm. They're actually they can be like a bit of a, what do you call it, a nuisance, like invasive.
Not the Kentias, not the Kentias. The cocos are your problems. Yeah.
Cocos palms.
Yeah.
What's a Kentia palm? Well, that size Kentia palm, what's that worth? It'd be $90, $100 wholesale?
Well, they wouldn't be that healthy looking, to be honest with you. But if you get let's say a 500 litre pot version of that, a variety, let's say 2.5 meters tall, and it's got a head of maybe a meter and a half across, you're talking $1,000 or $2,000. The big girls and boys, and I have transplanted a few in my times, they can be upwards of 10, 15, 20 grand.
For a palm.
For a Kentia palm, not all palms. They're very slow growing and quite temperamental, may I add.
Much like the property market.
Much like the property market.
So is that much a Kentia palm, like a
very
mature Kentia palm?
Mature Kentia palms are awfully expensive.
What's the chance of putting it in the ground and they're dying? Are they pretty durable and hardy?
They're pretty. I would say they're temperamental at best. Yeah. So you do typically, and I've done a few. You get a good horticulturalist to figure out how to transplant them properly.
Okay. I've tried to transplant plants before,
unsuccessfully.
I've tried to.
You think you just dig a big hole and then put in another big hole and put lots of water and fertilizer? That's the mindset.
I've tried to do gum trees. Really hard to try and transplant.
Big root.
Yeah, they've just got a big sort of thing. It's just, you're better off just buying them. But even then, you're not guaranteed. Just to even buying stuff, it's just you got to nurture and care. It's very expensive. And like a property portfolio, you got to nurture and care for it. You got to buy the
lots
right
of
thing. Lots of sea sole. You do need sea sole. Manure. I just loaded that with manure.
No shortage of that in your house, no doubt.
Find it, but so rates went up.
They did, not unexpectedly. It's been talked about for the last 6 months. So here we are. We've got post-Christmas inflation numbers come out and stripping out all of the guff that they typically like to strip out in those seasonal times. They're still unhappy with where things are tracking. So tap the brakes a little bit and let's see what happens. I think we'll probably be sitting on this for a good few months. And the new regime of not necessarily seeing the RBA catch up every month will probably mean that they've got probably up until May, I think, before any other decisions are likely made at this stage by the looks of all the commentary.
Yeah. Well, I think as it sits right now, we're literally catching up 2 days after the rate announcement. I think where it's sitting right now, 3 of the banks are saying that's it. And one of the banks, which I think is Westpac, is saying more to come. So time will tell to see how that changes and shapes as new economic data is handed down. But it's strange, to have a cycle where we had 3 reductions last year and then straight back up. The start of the year. It's looking back through history, that doesn't happen very often.
It doesn't happen that often, but it's also interesting. I was watching about a 20-minute bit on Chris Joye from Coolabah Capital, who's renowned quite highly in regards to the bond markets in particular, and sort of trying to follow the money markets and making arbitrage there. I was looking back on a video of him recorded, I think it was in September 25, where he was talking about more global rates and expectations, but referring to Australia at that time. And this is literally less than 6 months ago. and expecting that Australia was at a terminal rate of about 3% at the time, which is really interesting because data does shift quite quickly, and at that time we're probably on that downward trajectory, and then it started to show that it got sticky, and then sort of started to creep up again. So, I guess it does explain the fact that what we are in right now is semi unexpected, but it's needed, I guess, and it's going to have some implications. But I don't think anything too dramatic within the property market necessarily.
No, and we get into that today. I think most of the stuff that I'm reading right now is a lot of finger pointing going on about who's responsible for sticky inflation, and a lot of people are firmly pointing their finger at the government who isn't claiming responsibility for it. They're saying nothing to do with us, nothing to see here. But I think it's pretty clear that government spending is really driving the inflationary cycle.
They haven't said a word about that either, have they? No, they're blaming everyone spending too much on sector. Restaurants and their booze and their festive season and all the other things.
It's got nothing to do with childcare subsidies. It's got nothing to do with the fact that they artificially reduce power prices by just giving people cash.
Some fuel excise changes, a couple of promises out of elections, and other things like boosting some random projects. Which do they need to go ahead? Does all that money need to get spent in such a short period of time? Well, this is the outcome
as well, right? They I don't want to go back to it, but little things like this, the taking 25% of every kid's HECS debt. Like that doesn't mean that kids are paying off their HECS debt faster now. They've got more money in their back pocket.
They don't have to worry about it. So they're being frivolous.
And what are they, seltzers these days, what they drink.
This is
just more money in the system.
It just makes them think, well, I don't need that money to pay this back, and therefore all of a sudden, hooray. And, the people who spend quicker are typically the ones with less commitments, and those 20 to 25-year-olds, 25 to 30-year-olds historically just have less financial commitments, so they will throw that money back into the economy. Yeah,
and half of all investment properties are positively geared, right, as well. So there's money out there. A lot of people sort of always revert back to this idea of like the struggling Australian family, the cost of living, which, there are pockets of Australia which certainly like that, but there's a whole cohort of people who, retirees, for example, with no debt and money in savings, they're all getting a bigger return on their savings or investments now. So, you're going to get a lot of finger pointing, I think, as we sort of work towards the May budget, that the government's already talking about where they can sort of trim some spending, but I can't see anything is really going to change the situation moving forward. So I expect sticky inflation. Okay, what does that mean? Well, there may be more rates coming up, and I would be planning for more rate rises if I was making any investment decision right now. Plan for the worst and hope for the best. So I'd be factoring in, maybe a reversion to where we topped out in the terminal rate last time. So I'd be pricing in another 50 basis points, potentially 75 basis points. In any you're borrowing. Absolutely. Over and above what the bank may be telling you.
And I guess this is a question for you, Phil, and it's more of a rhetorical question, but as a property investor and as a property investor myself, the thing that I look at then is, okay, well, we don't have this. If I just go then narrow down for property, and so what for property investors, and let's just hone in on that, because that's what this is all about for us. If I'm looking at basically every major metro market and even major regional markets right now, and I look at the housing segments and look at vacancy and think, okay, well, are we sitting in 3%, 4%, 5% vacancy rates? Look, like I couldn't tell you where in any major centre that exists right now. We're still loitering around that 1.5% vacancy, which normalised markets, balanced markets are 2.5% to 3.2%. So we're a mile off that. What happens in these situations if I'm carrying an extension of increased cost? Well, I'm going to push towards, okay, maybe an extra $20 a week increase is probably what a lot of property investors' mindset might be on the next rent review to cover the costs that are going to come from this. And it can happen because supply is so tight and vacancy rates are still so tight. This won't equate to more supply ultimately being built. If anything, higher interest rates, higher cost of money, less property being built because the ROI for developers decreases again. So it doesn't help the situation in the housing market.
And I want that to be a sort of major thrust of our conversation today is in relation to supply, because I'm getting a lot of sort of panicking, jittery people on the phone and on email, sort of worried about we're moving into a rising rate environment. And my message to everyone is clear. It's business
normal.
As usual.
This is very normal.
It's just factor it in. As long as you're inherently confident in property as an asset class, and you're actually making the right decisions in terms of, where you're buying and why you're buying there, and your strategy around it. It's just a normal market. So don't get absorbed by the rhetoric that you're seeing coming in the media. Don't get too involved in, the wagging the fingers or the finger pointing around responsibilities around inflation. Like, most Australians have no bearing at all on influencing that. So just get on with it. Control what you can control. Don't be too concerned, but be alert to what's going on around you, because it should shape your decision making. But don't panic about it. But it comes back to the property market holistically, and why the argument is it remains a good, strong asset class, and that's what we'll get into today as part of what's making property news.
What's making property news?
So, Paul, what's making property news? We've gone through, we know what's happening with interest rates. Running in parallel to that, just before we get into some of the structural stuff around supply and demand, I've already started hearing murmurs around potentially changes to the tax regime. So when inflation gets sticky and the government is, let's be clear, that the government's budgeting isn't very effective. If the government was a family running their household, they'd be in dire straits right now, because they're spending a lot more money than they're making. So how do you fix that? Well, you stop spending money, or you borrow against it, so you take on more debt, right?
Yep.
A lot of Australians will find themselves in this situation, and typically they'll call that financial stress, and they'll be doing a whole bunch of different things. The government's actually in that situation right now. So what do? Well, they're not going to be cutting anything at any point soon, I don't think. They're trying to sell off stuff.
I saw that.
Defence
big
estates.
defence, couple of billion that they're trying to raise there.
Trying to raise it. But so what do? Okay, we'll fiddle again with taxes. So Australia being one of the most taxed places in the world, you get taxed every step of the way. Now they're talking about, well, maybe we can raise some more funds by reducing the discount for capital gains tax. Tell us about what you're hearing.
Well, how they're planning on reducing the discount is still what will be coming out potentially, maybe a couple of weeks before the May budget, and more discussions will get leaked prior to that. But if we cast our minds back, this 50% CGT discount was implemented circa 25, 30 years ago, right? So prior to that, there was no discount, but there was also some other benefits for property investors as well. Where they're looking at is that if you buy a circa property for $500,000, or you did so, let's say 10 years ago, and you now hold that same property at $1 million and you're considering cashing out, the $500,000 profit on paper, half of that is yours in the bank with zero tax. The other half is then applied to your capital gains or your tax regime at the time, or that financial year. So $250,000, realistically, you're going to pay top tier tax on that. That remains, but what they're looking at doing is shifting that 50%, that's a free pass, to maybe making that less. So effectively, the talk is, do they grandfather people who've bought prior to this implementing, and what happens with that? For me, yes, look, if that played out and the government could reap more tax benefits because of that, great. That's tax receipts that are earned. Now, is that actually great? Look, it's debatable, but for me, it always comes back down to why are you doing it, and how are they going to spin this to say this will benefit Australia? Because this, like to your point earlier, Phil, is like, are they trying to just essentially get more money back because they don't have enough money? Of course. Are they going to try and wrap it up in some sort of blanket that looks shiny and distracting, which may be talked about creating more supply? There is absolutely no evidence for me to show that raising or cutting the CGT discount is going to benefit both owner-occupiers, renters, and certainly not investors. And what it doesn't do is address anything to do with supply. Because if we look at it as we've got a pie of property, and a portion of that pie, you're not growing that pie by reducing the CGT discount. All you're doing is essentially saying that every time a property is sold, we just take a bit more of that. Thank you very much. What it doesn't do is address the cost of developing property, the time to develop property, and also the demand that comes from the existing property that sits there. We sit in a pretty much a systemic deficit now of 5 to 10%, not enough property in the Australian property market versus the demand, both on the household makeup as far as how many people want to live in a property and how many people are coming into this country who are demanding property, whether it's to buy it or rent it. So it won't affect the dynamics of where the fundamental issues lie on the supply and demand ratio. All it's going to do is create more tax receipts, which, we saw this once before, only less than 10 years ago, leading up to an election, which lost the election, which couldn't be lost. They are in a bit of a different position now, unfortunately, or fortunately, depending on which side of the ledger you sit on. But it will be interesting. And for me, look, if I was sitting in Labor's shoes, would you be thinking this is the time to discuss this? Absolutely. Because they've got a majority, they've got an opposition in turmoil, and they basically have a free pass to go nuts on this right now. If there was ever a time they're going to have a crack, it would be now. Whether it's going to be received, history tells a lot. So it's going to be an interesting 4 or 5 months, I think.
Oh, it will be. And it's an important point in that we have such a weak, we live in a democratic system. The role of opposition is to hold the government of the day to account, question, query, support when there's there's commonality in their positioning. But we have such a weak opposition that there is no one there to hold the government to account. The best you got now is First Nation, right? Who's actually got a voice. And you sit there and you scratch your head with a minority party now. So there's some problems there politically, and I can't really see that changing this term. So no. I'd be expecting, unfortunately, for a lot of property investors, another term, depending which way you're wide politically, of a Labor government, right? So they've pretty much got the carte blanche on decision making and knowing that they can push most things through, even though they're getting so many things wrong. They'll still push it through. So messing with the capital gains discount, meaning that you've got to pay more tax if you're selling property which is that has capital gains connected with it. So you don't pay capital gains on your principal place of residence, right? So that sort of keeps one cohort of the Australian populace happy. So this is firmly directed at property investors.
Correct.
Or people that may hold even a principal place of residence in certain structures for whatever reason, company structures or trusts or whatever. So it's firmly targeted at that. So which is really their opportunity to have a crack at investors without having to mess around with negative gearing. And it's a contingent tax as well, right? So you only pay capital gains tax when you liquidate the asset. Now, my concerns, and this is supply and demand discussion, is that it's just going to make property markets less liquid.
Well, this is it, Phil.
People are just going to go, I'm not going to sell it. I'm just going to hold on to it. I'll just ratchet the rents up, or I'll just refinance it. You don't pay tax on debt.
No, absolutely.
So if you've got serviceability, you'll just take your money out through debt.
And I guess the other part, which it doesn't address at all, is that that's 100% correct, is that I have then less intention to sell if I'm going to take a property off the table that's got my 50% CGT discount. I mean, why would I sell it to replace it with something else that I don't get a discount on? Let's assume that it's just completely abolished. And what that does for those new investors is it creates less new investors, which there in turn creates less rental supply for renters. So how does it address the vacancy rate issue? Because vacancy rates or rental properties aren't just created by new property. They're created by owner-occupied properties being sold to investors to then become rental properties. And unless the actual cost of construction and the supply of new dwellings decreases and you can create more, there is not going to be more properties for renters. And historically, that's still hovering around that 35% of all properties are on the rental market. That hasn't really changed for 50 years. Now, if less investors buy property, then you have less rentals. So then vacancy rates will drop because demand's still increasing.
Vacancy rates can't drop much more than what
they can't drop much more. So what happens? Rents go up. I don't understand why that 5-minute conversation hasn't, if it has been had around a table, what do they expect? I mean, look, let's assume that they're trying to do the right thing. They obviously aren't thinking about those things. But I guess your conspiracy theorists say, look, there is no intention to change the value of the property market or the value of rents. Ultimately, we know what's going to happen. They're both going to go up continuously. What is going to happen is that they're just going to take more tax receipts along the way. That's the reality.
And smart operators with the right advice will be able to maneuver through it. It's again, look, I pity the policy decision makers because every decision you make has got good reasons and bad reasons. Yeah, you raise some more tax receipts, but you're going to stifle property markets.
It's not going to happen anytime soon either. I mean,
No.
let's assume that it's grandfathered from, let's say, sometime May 26.
Yeah.
What happens? I mean, you have to make a gain to sell to pay more tax.
Yeah.
So typically, the pain and gain report always refers back to 6 to 6.5 years a property needs to be held before it's made a meaningful gain.
Yeah.
Before you strip out all your expenses, acquisition, sale costs. So from the day it's implemented in 2026, on paper, if history plays out the same way it has forever in this country from residential property and commercial property, you got until 2032 before technically any of these properties will actually yield any profit to then tax.
That's a good point. Yeah.
That's 3 cycles. That's 3 election cycles away.
It is. And no doubt, hopefully on the economic modelling, they sit there and just go, okay, so if you reduce through introducing this scheme, so halving the discount that you get, if 20% of properties are held rather than selling it, that means that 20% you were only giving half a discount on, now you're giving a smaller discount on. There would be a line where it crosses where you just go, this just doesn't make sense.
No.
And I'd like to know what that number is.
Yeah, absolutely.
If someone's smarter than me mathematically, would be able to
it wouldn't
work
take
it out.
much because they'd just punch it into their abacus and say, well, here's your essentially diminishing return line, and then it goes from there. But I don't know. Is it a vote grab? Do they need a vote grab? No. At this stage, I mean,
they need money, mate.
They need money
because they're spending like drunken sailors.
This is it. Like you either stop your spending and incrementally say, okay, for the next 3 years we're going to reduce this, but I mean, again, going back to my point, if you tinker with a subsidy discount, it's not going to create tax receipts. So if you need money, this isn't actually going to give you money now.
Assuming that they grandfather, if they go back and ungrandfather it, they're going to have a lot of problems.
They probably won't find themselves in power next term, I think, if that was to be the case.
Whether or not there'll be big enough movement, all your retirees will be up in arms.
And I guess the other question, I mean, the subsidy discount doesn't just apply to property, right? This is
true.
the thing too. So, I mean, this isn't just property investors they're talking about.
It's all assets.
All assets, all investments.
But, and you don't know what they're going to do with death taxes, right? Like, that's another thing. You just like, they'll have a crack at that. They've had a crack at everything. How does opposition get their crap together? I mean, this is the frustrating part, right? Like, I mean, they would have so much fodder right now to go, okay, great. This year is sorted. We've got this stream, and this stream. If we can't make some great inroads here based on these decisions, they're just wasting so much time. Well, I saw Littleproud, the leader of the Nationals in Parliament yesterday, he's had a crack at the Treasurer, saying, explain this inflationary thing, and the Treasurer stood up and it was just like his response was something along the lines of, to one of the 3 right wing parties of Australia, blah 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 blah. It was just such a inappropriate, dismissive response. That it's okay to be the toughest kid at school when you don't have.
Yeah,
anyone else?
There's no one to fight. There's no one to take you down.
Be very careful. Like, they might be in a bit of a lost state at the moment, but hopefully they'll get this stuff. I don't care who is in.
No,
the government needs to be held into account, irrespective of whoever. And right now, when you're just spending, and they're spending on stuff that most Australians. Maybe this is where I'm sort of a bit disconnected. I just sit there and just go, I'm getting no benefits from any increased government spending. Me personally, I'm on the other side of it. It just costs me every time. Where they're injecting this stuff, I don't use any of it.
Yep.
I just don't use any of it. Right.
Yeah.
So they're very certain aligned to strengthening their core constituency right now, which is this sort of middle Australia out there.
Yeah.
Your heartlands of which were traditionally. Say the western suburbs of Sydney, right?
Yep.
Where your Aussie battlers are, your blue, where we grew up, obviously.
I mean, the Greens
and your
your
migrant population as well. The Greens hasn't got a voice right now,
and they've ruined it. If anything, I mean, we don't talk about it, but unfortunately, the Greens have got a lot to be spoken for because they are a big reason why we're in this problem because they went so hard left for a prolonged period of time that they lost that wedge that probably were taking away from Labor's left, and now they've gone and joined this sort of middle ground where if they didn't go so hard, and particularly I went hard on housing, just ridiculously left-winged housing policies, which were never going to fly and were just completely made up, falsified information, that then lost their pressure in all these conversations too. So Labor has just seemed to get a free ride everywhere they looked for the last 5 years, and this is what the consequence will be. So I guess when it comes down to, though, we can talk politics till the cows come home because there is a lot that affects property. But when it comes down to what is actually going to affect the numbers, we see a CGT discount changed. Is it going to affect property? I don't see how.
Is it going to change anything that you do?
No. I mean, if let's assume that come May, I don't get a CGT discount on property. Am I going to sell existing assets that I own? Absolutely. I would consider no a lot more. To your point, I'm talking a lot more about refinancing that property, and I'm talking about also increasing rents, because what I would be very confident in is we're going to see less buyers come and buy investment properties. There's certainly less properties being built because we've got an issue with cost of development and speed of development, and we just saw an interest rate increase, so that won't help that situation at all. So for me, what does it do? Well, it means that what I've got is going to perform very well. Cash flows are going to benefit over the medium term. Will I buy more assets? I'll probably be. I'm planning on buying personally this year. So am I going to buy differently? No. I never buy with the intention of I'm selling in 5 years or 10 years anyway. So
it might change. You might sort of slightly alter your properties you buy to more yielding properties on that basis.
Maybe.
Potentially.
And maybe more properties will become more yielding properties because of this as well. And that is what potentially the flow on will be, is that properties will see an increase in yield because there's less supply, but there's higher rents. And then all of a sudden you've got this issue with, people paying the maximum they can, and this affects inflation more and more.
Oh God, I don't want to get into this 5% deposit scheme. I sort of had a go at it the other day.
Well, there you go. I mean, we haven't even talked about that. But I mean, point in case is you've got this, in October last year, you literally had the same government give everyone an opportunity who was going to buy their first home to basically buy $1 million home with $50,000. That's it. Yeah. And then the same token, you say, okay, well, we've done that, and now we've got this, and this coincided with this inflationary issue, and then all of his price pressure issues.
It's got to go down, I reckon, that 5% scheme. And I don't want to say that I told you so, but I've been telling people so.
People can rewind back to, we did podcasts on this September and October saying, here's what's going to happen.
Yeah. People are going to borrow the absolute maximum with a 95% lend at probably higher interest rates. And they've been told by the government that interest rates are going down, so it's nothing but see here, nice and safe, and now interest rates are going up. You're going to create a generation of Australians potentially negative equity and stuck for years in properties that they can't afford. Yeah. You talk about the housing crisis, the cost of living, you're just manufacturing that. So, the Labor government often puts some bad policies in place. I think about the pink bat scheme. The consequence of that was bloody, you had young unskilled apprentices stuck in hot roofs dying. Yep. Horrible. Which I don't think they've been held to account appropriately enough on that.
Yep.
Yeah, this is a different outcome. However, you're going to be putting a lot of Australians in stress who are going to say, I didn't subscribe into this. You told me this was like a risk-free thing, and you helped me get into the property market.
Absolutely. Or would they give them a free pass? Like, what would otherwise have been another 3, 4, 5 years of graft to save not only deposits but also stamp duty and all the other things that go with it? That happened immediately. And then couple that with HECS debt reductions and all that. It's the same cohort who all of a sudden had a massive reduction in their debts, plus they could get into a property at the same time. It just meant, bang, here we go. Yeah. And that's how inflation works.
Easy headline-grabbing, election-winning claims. And the chickens come home to roost. So let's hope. Look, it really concerns me. I don't want to see younger Australians struggling because of property decisions that they've made. However, this is where we're at. Now, you're talking about supply and demand, and this is the core thing that drives and shapes property markets. And your sort of position here, which is based on numbers, I don't know where you've got them from, but I'm assuming they're accurate, is that we're sort of 5 to 10% short in property. So how do you fix that? And let's remember also the tax regime in Australia supports for private landlords. 90+% of all investment properties available for rent. I think it's about 95%. I can't remember the number. Is owned by private investors, guys like me and you. So that means that market isn't necessarily skewed by government intervention. So people will make their investment decisions based on the financial sophistication, the financial sensibilities of making that investment, something that the government doesn't do. They just throw money around. So developers aren't developing, to your point, because it doesn't make economic sense. The margin isn't big enough for the risk that you're taking on. So that's slowing dwelling developments. Dwelling approvals is down, from what I understand,
and consistently
down from where they've slated to be. And then there was always talk about sort of affordable housing and all that sort of stuff. You hear this stuff banded around with different schemes. Now, juxtapose that with the fact that net overseas migration is still well above COVID levels.
Yep.
So more people come in Australia, and we're not building enough houses, which means that, and most migrants rent initially. We've got vacancy rates which aren't at a market sensible level, so 1%. Everything's turned on its head.
And I look at it to say, the thing that my mind would turn to very quickly to say, how do we fix this quickly? Well, you could say, okay, well, let's stop migration. I mean, people might be thinking, well, why do we bring so many people in?
And there's people
absolutely
vocally advocate on all levels of
absolutely.
politics.
And the biggest problem we have that answers that immediately is that we have a 4% unemployment rate. And we have wage growth that is well and truly above where the RBA wants it to be. So we have an inflation problem. So we don't have enough workers. We're not creating enough. We're not creating enough internally that are needed to create to stem the shortfall of what we need as far as skilled labour in all the sectors that are needing it. So therefore, wage growth continues, inflation continues. How do you get inflation down? Well, you need more people. You need to bring up unemployment rates, and you need to bring down wage growth, which then ultimately has an effect on all of the costs and services and living. So that's why that won't change anytime soon until we see unemployment creep up north of 6% and wage growth come below probably 2% annualized. You can't really have a solution to go and create more people in the workforce unless you're bringing them in and bringing in skilled people who are ready to go. And those people, as you pointed out, Phil, they need somewhere to live immediately, and they will historically move to the major cities immediately, and they will rent for the first 2 years immediately.
Yep.
We don't have enough supply. We also have all this issue. So yes, you can say, well, One Nation might come out and say, we're just going to ban migration or put a moratorium on migration for the first 12 months. They will come in with election promise, something to that effect. You can say it, great, and you'll get the benigns think that's a great idea. Well, then all of a sudden expect that prices will continue to increase exponentially. And that's unfortunately where the conundrum is. So if there is not a silver bullet there in the migration conversation at this stage. And
well, structurally, we need migration.
This is it.
In order to ensure economic or GDP advancement. That's reality as well. But you've still got pockets of the Australian population who claim that migrants are taking Australians' jobs. Well, they're not.
Well, in that same vein, mate, we took Australians' jobs. You know, we're migrants. Well, I mean, we're migrants at some stage. I mean, we are a country of migrants. That's just the way.
They're taking our jobs. No, it's really good. It's where I get most of my. It's where I do most of my economic research.
Those out there, yeah.
It's where I do most of my economic research.
If we come into this, so South Park said
the brilliant thing about South Park, and if you don't watch or watch South Park, because of the immediacy of it, it's within a week. Like each episode is like within a week of what's happening with the news cycle.
It's very current,
and obviously it's satire.
Yeah.
But it's a real insights into the psyche. But we need there's some areas where we're oversubscribed with workers, right?
Yeah.
There's some areas where we're certainly undersubscribed with workers, and you look at those areas which are most contingent or connected to what we're talking about here, supply and demand, is skilled trades, to build stuff, right? So materials to build stuff is a lot more expensive than what it was since COVID, and it's
permanent.
It's sort of stabilised a bit now, but it's
increased, and now it's permanent.
That's permanent.
Yep.
The people that put that stuff together is where the issue is.
Yep.
And I am not seeing enough from the government, which I find surprising, because it was typically their heartland for voters was the blue collar, blue collar economy, blue collar workers. So people that work with their hands, right?
Correct.
Are the people that we need in Australia right now.
And that's not going to change through this whole AI boom and all the other things that
it's going to manifest in everyone. We were talking about it. I think I saw even a YouTube clip of me or you talking about it, saying, I think it was in relation when they cut the HECS debt. Just going, giving all that free money to university students who are probably working, unfortunately, in, muddling your cocktails or serving your coffee, right? They're not working in the professional area that they work within. I just said, just double tradies' salaries,
Yeah.
like double apprentice salaries.
Yeah.
Like apprentices don't become apprentices. They look at it and just go, I can't live on that.
Or double incentives for tradies to take on apprentices.
Absolutely.
Anything to do with that
Absolutely.
sector. If you want to put a solution,
give
that'll be way
tradies,
more
yeah.
immediate. Give tradies the ability to get more team members, to build things quicker and cheaper,
Yeah.
and they therefore will profit from it, and therefore the Australian housing market will see more supply come to the market.
Yeah. I'd be going, hey, any trades-orientated business, give them a flat tax rate
Yep.
of 10%.
Yeah.
And I tell you what, a lot more traders will run. They'll run their books properly through the system. Rather
you
than
probably
doing
collect
cash
more
in.
tax receipts.
You'll get more tax receipts because you get more GST collected through it because there'll be less cash jobs, right?
Yeah.
And they'll look to grow and build their businesses. Give them just go tradie businesses if they're legitimate.
Yep.
You know, zero tax for 5 years. Hire apprentices.
Hire apprentices.
That money that you're not paying out, give them some
Invest
more money.
in TAFE to put more TAFE teachers on to
Yeah.
bring more apprentices through the system, and you will find a solution to this in 4 to 8 years.
Fix it.
And it will start pretty much immediately. Couple that with maybe a 12, 24-month increase just on pure skilled labour to then say, that's our medium to long-term plan, and here's our short-term plan.
Yeah.
And then bam.
Mate, $0 tax. I'd set up a trades business.
Well,
I'd go and hire 10 carpenters.
and they're
go and win some
screaming out
work,
for
you
them.
know?
They've been screaming out for them. You know, if you look at, I mean, the beauty about the housing market is that the building and the supporting building fraternity, there is demand there because when you're in a shortfall, there is always going to be demand. The challenge is they're not making more money. They just can't get the people to essentially allow them to get these jobs out of the ground as quick as they want to because the demand's not going to stop.
Yeah.
The problem is that they can't say, okay, well, I'll undercut XYZ builder or XYZ plumber or XYZ chippy on my quote because they're not exactly going to make more money. They have a problem because their labour costs so much. Materials aren't going anywhere, so let's just assume that materials are going to cost what they cost. But to bring in a brickie who's earning $2 to $3 a laid brick, where 6-7 years ago it was half that, they're all of a sudden now earning a good brickie's earning $200,000 a year working for himself with zero issues where it just wasn't the case. Now, I want people to earn good money, but you know, if that wasn't justified, you need more brickies. It's a pretty simple equation.
But they're out there though.
They are there.
They're out there. You know, you see them. You know, even the UK. UK is a great source of trades.
Full of it. And good trades.
Itching to get out here,
They
right?
are,
But
absolutely.
they still make it so difficult. I'd be going anyway. They should have a bus at the airport. Come in here. You know, get them in.
Yeah.
You know, and but still the immigration, the visa system is still really antiquated. It takes so long, so much time, so much effort. Open it up. But, you know, if you haven't ever been on a building site, do yourself a favour. It's a multicultural spectrum.
Absolutely.
You know, I've been doing stuff recently, you know, my tiler's Korean.
Yep.
You know, the plasterers and the painters are Chinese, the plumbers are Italian. Like, they're from everywhere.
Yep.
Couple of Aussie chippies from the Shire.
No doubt. Probably the highest cost. Overcharging. Shout out to my Shire chippies.
Yeah. Mate, that's one. Mate, I reckon the Shire overperforms with tradies.
Oh,
I don't know if they make them. They move there eventually. But.
They genuinely, as a ratio of professionals, I think it's one of the highest local government areas for actual trades in Australia. Now, they're certainly not the cheap trades. They certainly aren't struggling, but there's a lot of them there.
So new dwelling demand is about 180, 220,000, right? So that's immigration plus natural increase, a smaller household. And we've got to note also is the way in which Australians are living has changed considerably. You have a lot more people now that just live a single life that may not choose to have children, and they're still living in 2-bedroom apartments, right?
Yep.
You know, because they live in a bedroom and they use one for alpha.
They definitely do.
Yep. So it's completely changed. You know, the demographics, the number of people per household is changing. You know, not enough is happening again in terms of policy development to champion the transition of retirees or empty nesters out of their massive houses into smaller stuff.
I
you know,
agree with you
they've
there.
banded around, you know, giving them breaks in terms of stamp duty and stuff, but
that's not really going to change
nothing
anything.
really,
And I
really
think
happens.
the reality is that's not going to change. Credit where credit's due. There has been some big changes to zoning, particularly in New South Wales, which incentivizes probably not necessarily the owner-occupiers who own these blocks, these old school 600 square metres that were in good locations, to sell them. They have seen an increase in value because of these zoning changes. But what happens is you turn a 600 square metre block into what was a R2 low-density dwelling zoned area to maybe R3 and allowing for 4 townhouses or potentially even a low-rise apartment block. That's all good and well, but it goes back to the conversation that we had a second ago, which it's still not feasible.
Yeah.
Until you can build it, you're not going to see it happen. So you can incentivize these people to get out, but who's going to buy it to replace it with something that's more densely
So I
built?
can't see anything in the immediate to mid-term horizon which is going to support the changing of the economics for development.
I don't. No.
The
Personally, I don't
only
either.
developments personally I'm seeing going up right now are real high-end, high-spec stuff.
That's it. And
you see it around. We're in North Sydney. They're all fancy. They're fancy joints,
yeah.
right?
And they're more, in a lot of cases, they're more expensive than the houses that people are moving out of.
Yeah. They're essentially what's getting built that I'm seeing around sort of my immediate area is where downsizers are moving to. Rich downsizers.
You're right.
You know,
7 Hills.
yeah. But the cheaper stuff just you can't get it out of the ground to make it worthwhile.
To share a personal story, Matt, I've actually got a meeting with one of my development business partners tomorrow where I've spoken about this openly over the last few years where I bought a site in Sydney 3-4 years ago. It's benefited from this zoning change and it's gone from what was going to be a 4 townhouse development to now potentially 8 stories, potentially 32 apartments. And it's not in a entry-level market. It's not in a waterfront market. It's probably what I would deem to be in an emerging affluent market. But it's what we will be able to build will probably benefit those 25 to 30-year-olds plus also those downsizers to a 3-bedroom apartment accommodation. So it's going to have a mix of those different things. I've been working on this for 6 months and not just working on how to design it, but also working on how to build it and then what it's going to actually end up selling for on a per unit basis to try and figure out where the mark is. You'd think that if you bought a site that was originally bought with the expectation to build 4 townhouses to then go to 32 apartments, that I would have hit the lottery. I definitely haven't done badly out of it, but I tell you, when you're building at $6,000-$7,000 a square metre, which is kind of where I expect this is going to end up landing, and to do the math, it's about 3,000 odd square metres. That's going to be the total footprint. It's about $20 million. Once you factor in what our very earlier conversation was going to be, once you factor in the taxes, the holding costs, the exit taxes, and everything else that goes with it, the margin still isn't anywhere near enough for me to get super excited about, and further to that, for my banker to get excited about. So we're going through a stripping out conversation to say, okay, well, how do we bring down that $6,000 or $7,000 per square metre cost? What do we need to strip out? How do we strip it out? What do we build that's more appropriate?
Just ain't worth a squeeze. And it's all contingent on whether or not, when you're ready to sell these things, property markets are in the right thing and they're worthwhile.
Exactly. Like it's again to that point. It's this whole supply ratio. It's not going to change.
Yeah. So there's going to be structural undersupply for the foreseeable future. I can't really see anything changing it. That's bold, ambitious. Back to the government, they're worrying about trying to gouge more money to cover the costs they've got right now by looking at the tax regime rather than generally looking at how do you actually support these root causes. I can't see it changing. So that's just that's just the way it is. So what do you do about it as a property investor? Well, it's probably not a bad thing. And this is the irony of all this. And this is it. And this is a podcast for property investors, right? So you've got this, you can have this sort of sensible moral conversation around making sure housing affordable, everything like that. But then you go, but I'm trying to make money out of it.
Well, this is it. We're in this game to make money.
This is it, right? So which a lot of people are uncomfortable about and get quite frustrated with. So pockets of Australia going, why are you exploiting this horrible situation? Well, it's called an investment.
This is it.
You put your money where you're going to get your biggest return. It's called an investment. Now, I'm happy with it. I'm providing rental accommodation for Australians because the government ain't doing it. So there's been moments in time in our recent-ish history where we've been in areas where really tight supply and strong demand. Within our lifetime, we've seen this sort of 3 or 4 times. And the outcome of that typically is price growth.
Absolutely.
And so tell about some of these times where this has happened.
So sort of outlined here, I guess, some key historical times where we've been in relatively similar areas of historical high migration, high demand, low unemployment, high inflation, and also the supply issue that we're in right now. Late 80s, which if anyone who's listening to this was in the game back then, they would also know that correlated to north of 15% interest rates, but you saw an explosion in prices in that same time. Early mid-2000s, similar, where we had interest rates was actually slightly above where they are right now, and you had very strong capital growth across the market. That was also just before the GFC 06-07. We saw another increase in prices, and again, the demand-supply ratio was very similar. Post-GFC, we were in interest rates that were about the same as where they are now, and we saw a very close correlation to price growth in a lot of markets at that time.
That's sort of when we kicked off investing then, wasn't it?
Yeah.
Rode that growth.
Yeah, absolutely. And I mean, you kind of always, even back then you asked the question like, oh, is the past going to emulate here? And you sort of questioned, well, I wonder if that'll happen again. Well, here we are. If anything, it just keeps repeating itself. And, obviously post-COVID there was an extreme boom there. The only real difference in post-COVID was interest rates. But that wasn't necessarily coupled with the same migration. Well, not even post-COVID. It was sort of more 2021 where there was effectively no migration for a period of time there. But now here we are. In the last year saw 8.5% capital growth in 2025, and I expect we're probably going to be circa something similar for 2026 and likely to be 2027 and 2028 unless we see something dramatic change to the supply ratio.
Is this all good? What do you do about it?
Well, mate, what are you doing about it? I asked you that question. Are you in the property market? Are you looking to add to the portfolio?
I am in the game. I'm refinancing right now, and I'm getting pre-approvals done. So I think it's a great time. I spoke to my accountant yesterday, the day before. I can't remember.
Yep.
Talking about interest rate rises, and we both went, yes.
Yeah.
Yeah. Opportunity.
And your accountant knowing is also a property investor, right? And has been through these cycles before and knows this is what happens.
You're just going to take some of the heat out of the market, the other buyers, for a moment in time, which means that maybe less competition for stock. You may have the type of assets you're buying may become more attractive moving forward, more yielding stuff with a view towards these type of things. With a lot of people may be shaping their strategies for more hold, rather than sell. All this stuff is good.
Absolutely. And the refinancing game will play out more and more, I believe, because if there's murmurs of CGT discount cuts, etc., then people will say, okay, well, my plan is to take that money out. To your point, you don't get taxed on taking equity out of property, which is
a lot of people just live off debt because they never pay a cent of tax on
it. This is it. And then a lot of people think, okay, before I exit the workforce, I'll essentially take that debt out and leave it available for me to potentially use that, and may not use that for reinvesting, may just use that for the sake of using that. As long as my income covers my debt, I'm happy to use that debt to live my life.
Debt strategy is why you need a really good broker.
Absolutely.
Because debt can be a huge asset, and debt moving forward is going to become even more of an asset rather than you go back to your sort of high school finance education, assets and liabilities. Liability is a mortgage or debt. Well, no, debt can be a huge asset because
Absolutely.
It's getting harder to get. And as sort of technology continues to advance in the way in which lenders assess you, debt's going to be harder and harder to get. So you need to make sure you present a good case and you're well structured in that regards. But debt is an asset because it can be very effective in relation to how you choose to run your tax regime. Within the rules are there, the guardrails are there, set by the ATO. Work within them.
I spend more time on looking at my finances as far as extracting equity, recycling loans, and certainly not closing down facilities than I do on the acquisitions that I make. Yeah. Like the acquisitions that I make are typically made within hours. And I can speak to a property that I bought 2 weeks ago that I saw come across my desk from one of my buyer's agents. He looked at it and said, Paul, this is exactly what I think is going to fit within that SMSF purchase you were looking for. It was as simple as that. I looked at the details and said, what's your thoughts? He's like, it's a go. That was a conversation. Okay, let's get it happening.
Where at?
It was in the western Melbourne, 650 odd square metre, 3-bedroom brick home. It's going to yield about 4.1, 4.2%, nothing to shoot the lights out regarding cash flow. It's going to be a 30% deposit. It'll be close to cash flow neutral. For me, it's a park. It's a 10-year easy one. that's what I was looking for, and it came across my desk, and I was like, great, the money was already there, ready.
Cool.
I'm not interested in worrying about finding something that's going to be radically different to that for that particular structure, and it's worked plenty of times in the past.
Yeah, we've spoken about that in previous podcasts about sort of trading and transacting inside the SMSF, which for a lot of people is a bit of a taboo, but it can be a good place to do it.
It can work.
And the tax regime, again, is different in and around your SMSF, so make sure you get good advice about it. So it's probably not bad buying time.
I think it's very good buying time, and if anything, this is just going to solidify the fact that the data keeps solidifying the fact that we're in a structural issue, so a deficit of supply issue. So for me, until that dramatically changes, I can't see how we're not going to see another solid year in property. From a growth standpoint, there will be markets that are far more affordable to get in versus historicals, and that's probably the big part where you can get a bit more of a leg up versus markets that have shot lights out.
Let's remember also there will be areas, pockets of Australia where there is still oversupply.
Oh, absolutely. Yeah, there always is.
You know,
and property types in those markets.
And oversupply is an interesting thing, and I would caution our listeners around this is that oversupply can refer to where there isn't potentially the demand for rental stock in places. So there might not be. You know, there's a lot of areas where investors are chasing right now, thinking that they're getting good deals, but a lot of people don't want to rent them because they might be so far out of the city, or they might not have this, that, and the other there. So oversupply can mean not just the number of properties, but it's the makeup of those properties and the people who want to choose to live in them. You know,
and the demand of renters versus demand of buyers, and just because there is 50% of accommodation is rental accommodation, does that mean it's oversupply? Well, it depends on how many renters are in that market. I mean, there is data.
If the renters aren't there for it, it means oversupply.
But there can be markets that are 60% rental accommodation that are completely and utterly undersupplied for rentals because there is a much higher cohort of renters. So don't just think that the ratios have to be a 70-30 split of owner-occs versus renters or vice versa to see good dynamics. Every market has different dynamics that play out. Yeah,
that's what you need to uncover. That's what you guys do.
Absolutely. And this year is going to be probably one of, I expect, certainly is already shaping up to be our biggest year as far as acquisitions and speed of acquisitions on the ground, because I can think of we're probably at about 55, 60 properties we've got as a cohort that we've inspected already in the past 5 weeks. For us, that's we track how many properties we're inspecting that are off market versus what we're looking at versus what we acquire. We're at our highest number of actual properties that we're looking at that we have for the January month, which for us always tells us that we've got good supply coming our way as buyers agents looking for established off-market opportunities.
There you go. How do you track you guys down?
purepropertyinvestment.com or 1300 985428, or simply if you do want to set up a time to chat, just shoot an email to inquiry@purepropertyinvestment. That's an inquiry with an E, purepropertyinvestment.com. Set up some time to chat with either myself or with one of my team members.
Cool. Nice one. Well, thanks for coming in. I think we've covered a lot of ground there, and this sort of resounding message is steady as she goes, business as usual. Nothing's really changed. Yes, it's inflation's a lot stickier than expected and interest rates are on the way up. But if that's really shaping your investment decision making, a 25 basis point change to interest rates, you probably got bigger problems. So pull it apart, speak to the right advisors, understand where you're going and what you're going to do about it, and that's the right way to do it. Thanks. Good to see you. And thanks for tuning in. Everyone, lots of podcasts, go and tune into it. A lot of relevance of many of the conversations that we had last year, so go and tune into that on the Pure Property Podcast with Paul Glossop, the team over at Pure Property Investment. Go and check these guys out. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.